Welcome everyone to the next session in our webinar series. I'm here with Chris Mallon and Andrew Randisi. We're going to talk about 529 plans. I'll hand it over to you, Chris.
Awesome. All right, I'm going to share my screen here and bring up the presentation. One moment. All righty. So today, like Leslie said, we're going to talk about education planning part 1, 529 plans. So what is a 529 plan? There we go. It is considered a qualified tuition program. A 529 plan is a state-sponsored program allowing a contributor, so that would be, typically a parent, grandparent, aunt or uncle, to prepay a beneficiary's qualified higher education expenses at an eligible educational institution, or to contribute to an account for paying those expenses. In more simpler terms, it's an account that you can put money into that can be used for education, whether it be K through 12 or college or postgraduate education. I'll kick it over to Andrew. He'll go into some more detail about the flexibility of 529 plans.
Sure. Thank you, Chris and Leslie. 529 plans, as Chris mentioned, they can be established by, normally it's a parent, grandparents, aunts and uncles. They can even be established by the contributor for themselves as well, as a way to have a tax-free growth of education in a tax account, tax-deferred account. The beneficiary of a 529 plan can be changed at any time without consequences if a new beneficiary is a family member. That could be changing it to a wife, your daughter, your son, your grandchild, niece, nephew, even your first cousin. And this is also a great estate planning technique for grandparents if they'd like to start removing assets out of their estate to help benefit their grandchildren's education.
Yeah, to expand on that a little bit more, it's often overlooked in estate planning. However, it's one of the few accounts that you can set up for a beneficiary while still maintaining control of it. So, for example, grandparent opens account for grandson, granddaughter, and then that grandchild doesn't go to school, or they want to switch it over to another great grandchild down the line or a different grandchild. That can be done, and then they can still control the assets in the account, but it is removed from their estate for estate tax purposes. All right, some extra benefits of a 529 plan. The earnings accumulate tax-free while in the account. That is probably the most important one of the 529 plans. So the money goes in, it grows tax-free and comes out tax-free as long as it's used for higher education. The beneficiary doesn't generally have to include the earnings from a 529 plan or a qualified tuition program as income. This is important because when you apply for financial aid, you do not want the 529 plan to hurt you. So the money coming out of the 529 plan isn't considered income, so then you're not get dinged on the financial aid front. And then distributions aren't taxable while used to pay for qualified higher education expenses. And a new-ish rule in the past couple of years they added, you can use $10,000 a year for it, grades K through 12. So you can use it for private high school education, middle school, elementary school, all the way down to kindergarten, which is a new feature they added recently. And then amounts can be withdrawn to pay principal or interest on a designated beneficiary's or their sibling student loan. And you can use that up to $10,000 for a lifetime. So say, for example, took out student loans, have a 529 plan as well. When you finish school and you still have the loan balance, you can use up to $10,000 of the 529 money towards the student loan to help pay that down. Then interest paid with these funds doesn't qualify for the student loan interest tax deduction. That makes some sense because you're already putting the money in and it's growing tax-free, so you can't get the tax deduction you would normally get when you pay off your student loan throughout the year.
All right. So what would be considered qualified higher education expenses? And I'd say right off the bat, tuition and related fees such as the university fee, That's automatically you can be used for a 529 plan. But there's also some things that a lot of us might not know can be used for 529 plans as well. 529 plans can be used for room and board. They can also be used for books and supplies, any type of equipment, whether that be a computer, internet. It can also be used for special services that you might need as well. And it's not just for these expenses. You can also use it for, it can be good at any college. It can be used at a university, vocational school, or other post-secondary education, an educational institution that's takes student aid by the Department of Education. So you could use it for a trade school, such as if you said your son or daughter might want to be a chef, or they might want to be an electrician, and they have to go to the more specialized schools. You could use that instead if they did not chose to go to college.
Yeah, I'd say over the last couple of years, the 529 plans in general have been broadened out. When they first came out, they were kind of popular, but were often overlooked. And then as the years went on, the government has expanded it to be able to cover a lot more expenses, a lot more different schools. Before, it used to be like higher education, and pretty sure it was only tuition related fees. Room and board might have been able to have been covered. They really brought it out because with the rising costs of college, it's been a lot more flexible, which is good. And then one other tidbit we want to talk about: 529 plan super funding. So some background on this: each year, an individual can gift up to $15,000 per year to a beneficiary, a kid, a friend, something like that, without having to pay an annual gift tax form. So once you go over that $15,000, you'd have to file a gift tax return, so it can be kept track how much you've given away to that particular person. And then when you're married, you can do $30,000. You can combine it to a particular beneficiary. With 529 plans, you can do what's called super funding. So you can gift 5 years worth of gifting in 1 year, and then it spreads out those $15,000 for the next 5 years. So how the IRS sees it, then you gift $75,000 upfront to a 529 plan. We'll just keep it simple, so it's one contributor. $75,000 in year one, allowing that money to grow tax-free for over those 5 years. But then each year, your $15,000 gift for that beneficiary has already been made. So that's kind of the one caveat you have to be aware of. You gift the $75,000 in, the next year you can't then give them an extra $15,000 because that's already been spoken for. And then if you're married, you can double that you can each use your $15,000 gifts up front to $150,000. So this is, if you have the means to do this, if your parents have the means to do this, it's a good way to get a lot of dollars working towards education at once. So then more time in the market, more time for it to grow tax-free, where you're really getting the bulk of the benefit of the 529 plans. And then after the 5 years are done, you start over again. You can do another $75,000 or $150,000 in. Just one thing you have to make sure you keep track of, so you don't over gift to somebody. If you've already done this, you forget in year 4, you want to gift them more than $15,000. Just make sure you keep track of it, because it goes against your annual gift tax exclusion, as well as your lifetime gifting exclusion as well. I think that's all we have for slides. But now I know we have some questions that we frequently get that Leslie's gonna fire away.
I have a list of questions I was going to ask, but one just popped into my head about the super funding. So if you super fund and then 5 years passes and you want to fund again, if you don't want to super fund, can you go back to just doing the $15,000 a year after that point?
Yeah, for sure. You don't have to. You're not stuck super funding.
Okay.
Each year you can do the $15,000. Sometimes so there are some occasions where even if the client or family has the means to super fund, we don't always recommend it, because then you kind of lose out on the state tax deductions that you can get each year. So different states have different rules about what can be deducted when you gift to a 529 plan. So sometimes we don't recommend super funding because you can lose that. But yeah, you don't have to do super funding after 5 years past. So you can go back to the 15 or less or more.
And the one other comment on super funding is some depending upon the state, they only allow a specific dollar figure amount of contributions. For example, some states that can vary anywhere between $300,000 to $500,000. So once the account balance for, we'll just call it junior, would reach $500,000, the plan might say you're no longer allowed to contribute any more dollars. It's just what the account can continue to grow. So you might only be able to at most super fund twice, maybe depending upon the state. So long, with the market growth.
Right.
Okay, that's helpful. Good. And then how does one choose a 529 plan?
I'd say so there's a few different ways to go about it. Maybe a few different tools as well to help compare different 529 plans. I think at this point, every state has their own state-sponsored plan, and they all vary slightly. So how it works, a lot of time there'll be either a Vanguard or a Fidelity kind of in the background where the investments will live. The state will sponsor the program. So you have to evaluate, okay, what are the underlying fees of the different state-sponsored plans? Some are, there'll be a $25 administration fee a year. Others, there'll just be a flat like AUM fee. So it'll be anywhere from 15 basis points to 50 basis points to be aware of. And then the different investment options that are available at each state also varies. A lot of the times that can be, you put the money in and say, okay, what happens now? You have to look at what makes the most sense for the kid. If the kid's, just turned, was just born, probably makes sense to put them in a plan that is leaning almost 100% in the stock market, since they're not going to be going to college for, 18 years. Andrew, if there's other stuff you have to add as well.
A couple other things to also look for, picking up on the low cost. If some of our, viewers out there are familiar with Morningstar rates plans by the metals, gold, silver, and bronze, and then unrated. That's another way you can kind of do some comparisons. There's plenty of college saving websites out there that compare 529s. Fidelity's website has a 529 comparison tool, as well as there's a lot of personal finance websites like NerdWallet that that have comparisons. But it's best to, I would say, compare. First, start with reviewing your state, specifically where you are, and then compare that with what might be a Morningstar gold level option, or as well as some from the other websites. Because mainly what you're looking for, like Chris said, you want low cost. You want to make sure your low cost index fund have low cost investment options. There's not very, very high administrative fees in your plan as well. And you want to have a wide assortment of investment options to choose from. That way, if you're a more comfortable do-it-yourselfer investor that you like to pick your large cap stocks versus small cap stocks, you can do that. Or if you kind of just wanted to put it on autopilot, which I know a lot of us like to do, just set it and forget it. If the plan offers target date series or glide path, depending upon what the plan might call it, you start out when junior is 1 year old, and then put the dollars in, and the portfolio slowly becomes less aggressive over time. Then when it's time to go to college, you're in pretty much all very conservative capital preservation, money market type investments by the time your child's 18 years old.
Yeah. And one reason why to look at your own state first, some states have reciprocity between other states. So for example, in Pennsylvania, you can open up a 529 plan in a different state and still get the state tax deduction. Some states don't have that feature, so it makes more sense for them to open it up in your home state, because then you might lose out on additional state tax benefits that you can get.
And you could have, unfortunately, there's some states that kind of leave you out in the cold, like New Jersey, where I live. You don't get any tax deduction. So
Right.
at that point, you're just looking for what's the lowest cost, best option for my family and my children's education.
And you don't need to, like, say I choose the 529 plan for Utah, my kids don't have to go to school in that state. It has nothing to do with where they go to college.
Not at all. You can live with, for example, with the Utah plan, which is what we have through Pennsylvania Capital Management, our sponsored 529 plan. We have clients that live in Washington, Florida, New Jersey, Pennsylvania that all have have accounts with Utah My 529, and their kids are going to where do we have? Harvard, Emory,
Tulane, yeah, all over. Yeah,
Bates.
They universities don't care. They'll take the money from wherever it'll come from. There used to be, they've kind of gone away. There used to be prepaid tuition plans where those were kind of state specific. So I know in the past, South Carolina had a pretty good one. You can prepay tuition, so it kind of locks in the price as it is now, and then it can be paid up front. But a lot of those plans have kind of gone away because college has gotten so expensive. States don't want to lock you in at a lower rate anymore.
Okay, great. And then how about, I know we have some clients that have asked us in the past, if you already have an account for your child or your grandchild, sort of colloquially known as UGMA or UTMA accounts, Uniform Gift to Minor accounts, how do they relate to 529 plans? What's your thought on the comparison between those two?
Go ahead, Andrew. You go first.
I'd say so. We UGMA and UTMA accounts; those are great to have for your kids and grandkids as a teaching tool to start the financial education early, because that's one thing that a lot of school districts do not really start at a young age, is intro to finance, which we kind of really wish they would start the kids earlier. Those accounts are great. They can be very much used for college. There are a couple of, I would say, the UGMA and UTMA have more flexibility if you wanted to say use those for items that would fall outside of the college realm, such as if you wanted to buy a car, or if you wanted to go on a trip, or if you wanted to use it as a house down, as it could eventually become a house down payment for when your child or grandchild is an adult and wants to make that purchase their first home. The 529 plan has the main merit with the 529 plan is you're contributing dollars in and you're getting tax-free growth on those balances. In the UGMA and UTMA, you're going to be paying taxes each year. Might be just a little bit, but you'll be paying taxes on those accounts each year, depending upon how high the account balances get. Which, if we want to have tax-free growth for college, the 529 plan is probably the better fit than the UGMA and UTMA.
So I'll just say the trust accounts. And then the 529s, the trust accounts are good for, like Andrew said, very flexible. You can use them for camps, things like that. A lot of the times when clients ask us if they already have an existing UTMA, UGMA account set up, to keep that as it is and then open up a new 529 plan. Once you start to commingle, so you'd move the UTMA, UGMA account to a 529 plan, you lose some of the benefits of the 529s. You can't change the beneficiary anymore. And then you have to liquidate the assets that are in the UTMA account. So say you have, an S&P 500 ETF, you have some Apple, Microsoft in there, some individual stocks. You have to sell those, pay the capital gains, because in the 529 plan, it can only accept cash into it. It can't accept individual securities or securities of any kind. So there's some downsides to getting rid of it. And then a lot of our clients like to have it, that money almost be saved for after college. So like Andrew said, usually using that for down payment, really. So when they leave school, they'll have some money that they can use for, personal expenses versus just education.
Great. Makes sense. And you mentioned for those other accounts, the UGMA and UTMA accounts, you can't change the beneficiary. But my understanding is and I think you mentioned that on a previous slide, that you can do that on the 529, and that really seems to be one of the great benefits of it. In that, if you have a balance left for one child, you can then transfer that, right? So can you explain?
Yeah. So you have, say you have two kids, one gets a full ride to school, and then the other one maybe not. So then there's money left over in the plan after, junior's done. So then the third is coming up to go through school. He didn't do as well in high school, so he's got some extra bills to pay. Then you can just change the beneficiary and use it for the younger sibling. Or say both your kids get full rides, but you're a generous aunt or uncle, and then you want to give it to one of your nieces or nephews, you can change the beneficiary to one of them too. So it's pretty.
We have other clients as well. We have clients as well at PCM. They had set up 529 plans for their kids. There's between $25,000 and $50,000 left over after their son went to college. It's now going to be used for their granddaughter.
Yep. Very common as well.
And then so that you would change the beneficiary to your grandchild, and then you can keep contributing.
Yes.
Keep it
You
going.
can keep contributing, doing $15,000 for your grandchild. And if it's two grandparents, they could contribute 30.
And other people can contribute to it as well. So example, you set a 529 plan up for your kid with your spouse, your parents, so that the child's grandparents can contribute to the same 529 plan. They don't necessarily have to open up a new 529 plan for them. You can take outside gifts to the plan as well, which is a cool feature.
But you should have, if you have more than one child, you should have more than one 529. It should be individually for each child.
Yes, yeah, because then you can contribute to both. So say you can give more than between a husband and wife, or spouses can contribute more than the $30,000 a year per kid. It makes sense to add the two, so you can gift $60,000 for education per year. Versus if you have one plan with one beneficiary that you'd be using for two kids, you kind of cut yourself off the knees because you can't stuff as many dollars in there.
Yeah, and I guess it would be trickier too if your kids end up at college at the same time. Then who's the beneficiary? And
Right, yeah, it makes it much more of an administrative headache for sure.
Yeah. Okay, and I guess similarly to that, I think Andrew, you mentioned this. If your child decides not to go to college, right, you could use it for a trade school, or like we just said, you could pass it on to another child.
Yeah, and if the child really wanted money out of it, you can take money. However, there is a tax penalty, as well as you'd be giving up. Become taxable income on the growth that would come out as a distribution for non-qualified educational expenses. That's why it's best, to at least have whenever you take funds out. Have at least some documentation to have all your receipts for that. If you ever should have any inquiries from the IRS, you can back it up. Hey, we took out $10,000. It was for first semester at college. $2,500. It was for room and board. It's good to have those receipts to back up any distributions.
Okay, great. And I know for the 529s that we work with at PCM, we just send the payments right to the colleges, right out of the 529s.
You can send it straight to the bursar's office, or a check can be cut to our client, and the client can pay the bursar's office. But then that's where it's good to then have that bill on handy. That we got the tuition bill. It was $20,000 for the semester, or $5,000 for the quarter.
Right. Okay, great. I think that is all I have on my questions. Do you guys have anything else that you wanted to cover that we didn't go over?
I think we covered a good chunk. Yeah. There's always more, if anybody has any questions, you guys know where to find us.
Yes. Thank you for listening in to our webinar today. Please feel free to contact any of us if you have further questions about 529 plans or anything else that we can help you with here at PCM. Thanks very much. Take care.
Thanks, guys.
Bye-bye.